to another edition of Stock Talk. My name is Aman. I'm an investment coach here at Sage Investors, and today I thought we'd talk a little bit about my personal investment activity review. One of the things I take pride in with my practice is I really feel strongly in practicing what I teach. It's one thing to talk about teaching people how to make investment decisions, teaching people about how to read financial statements and analyze companies and value companies. It's one thing to teach people to do that. It's another thing to practice it and actually talk the talk and put your money where your mouth is. And so I take a lot of pride in actually practicing a lot and applying a lot what I've learned and helping other people with it. And so I try to express it in two avenues. One way is in real time on my Twitter handle at Sage Investors. Every time I make a trade or I make an investment decision, I tweet it out in real time. And starting this year, I'm actually using a hashtag trades 2016. So if you do a search on that, you'll see all my trades that I've made so far this year. The other way to do it is also every month I post a blog post on the decisions that I made the previous month, the buy decisions, sell decisions, and whatever challenges or the key investing issues I'm facing personally, and just an opportunity to demonstrate a little bit what my thought process is and how I face investment decisions on whether to buy or sell a stock. And chances are you're going to notice that a lot of the decisions that I face are what anybody else would have to face. So it's something I've been doing for a few years now, and now that I'm on Periscope and online kind of streaming kind of media too, I thought it'd be good also to just chime in on some of my own personal activity that I've been doing. So I just posted a blog actually this past week on my trades or key investment decisions I made in the previous month in February. So I thought I'd just share them with you. Again, you can go to my website www.sageinvestors.ca. You can see my latest post and also all my previous posts, investment activity review posts that I've done over the years. So basically in February, coming off January, which was a crazy month, the markets were just crapping out everywhere, and I was actually taking advantage of it and actually going out and buying stocks and initiated a lot of positions. February was more about adding to positions, and I made interesting. I made 4 key moves, which I'm going to share with you. The first key move is I added to my current position in the iShares European ETF, ticker symbol XEH. Reason why I decided to add to it was because in February the European markets were just having a hard time. The European equities were down like for 7 straight days. So the sentiment in February was pretty downright negative on European stocks, and usually that's my little alarm bell, or in this case a dingling bell, telling me, hey, you know what, I should start looking at some of these things, because if the consensus is out there pretty negative on a specific equity or a specific asset class, then that's really the best time you want to start building positions on it. So I used it to add a little bit more to my position in the XEH ETF, and part of the reason also is because the dynamics in Europe still seem to be the same, in which the central bank has been pumping money and buying bonds and doing their own version of quantitative easing in there to kind of keep interest rates artificially low to prop up the stock market, and it's happened to a certain extent. So I've had the position for about a year, and so I'm still holding it. And sure enough, after, this was back in February when I did this, but sure enough, last week the central bank came out again, basically went all in on stimulus and dropped interest rates to negative values, and more money printing. They even announced that they're probably going to expand their bond purchases beyond government bonds. They're going to be starting looking at corporate debt. So they're just throwing everything at it, and personally, I think it's a horrible idea. In the long run, I think it's going to do more harm to the European stocks and the European economy than it is. But in the short term, as we've seen this playbook before here in the U.S. When they did their round of quantitative easing, there was a short-term, sugar rush for stocks, and so I wouldn't be surprised to see if there's another pull-up for European equities too in that time. So that's my European position. Another move I made is I added to my positions in Visa credit card company. In February, there was one day in particular, it went down, the stock went down like 7%, and there was really nothing out there. There was no earnings report, there was no fundamental change in the business operations of the company, nothing. It just went out 7%. That day also was a big, broader market pullback, so it could have just been a classic throw the baby out with the bathwater kind of mentality that was out there. People trying to raise money, and despite the fact the fundamentals this is one of the, like, in terms of money printing, this is one of the best money printing companies out there. This company just throws cash left and right. The fundamentals are fantastic, and it's just embedded anywhere in the whole concept of fintech. You know, it may not be inventing much, but it is getting a cut of everything that's going out there. So to me, it's almost like the plumbing or the back underside or underbelly of the whole financial transaction system. And Visa, MasterCard, they're all getting cuts out of this. So Visa to me is best of breed, and I used that pullback that day to add more position to that stock. I actually put it in my son's RESP portfolio, his education portfolio. To me, it's just a stock. You know, for me, I buy it, and I'd be happy to hold it for years upon years. And just roll with that. Interesting thing also with the company is that they announced a more formal partnership with China's UnionPay, which is the only company in China which can sell credit cards. And last year, the Chinese government announced that they're going to kind of open up the market, the credit card market, to have other foreign companies come in and sell it. So like, cha-ching for Visa and MasterCard. This is a huge opportunity, and I could see it being really, really good. So again, another good fundamental reason to own the company. Quality companies. In my previous episode, talked about investment ideology. Quality. Visa to me is like one of those quality companies, long term, that'll do some stuff for you. Another position I made was I added positions to Potash Corporation. The stock went down into the low 20s, and I used it as an opportunity to add to my position. So my cost base on that stock is $23.60 now, $23.66 on it. So I've been steadily buying it down as it's been going down. Fundamentals are pretty crappy for the company. Potash prices continue to be low, depressed prices. But despite that, the company's taking a hit to earnings. Despite that, you know, it's still printing money. It's still making tangible economic profit in a depressed market, and that's one of the qualities I always look for in great companies to invest in, is companies that can demonstrate that they can make money in a really weak market. If they can make money in a weak market, when the pendulum shifts back, chances are they're going to be in pretty good shape. So I'm using it to buy the stock it's at a discount right now, and I'm happy to hold it. And as I said, I'm not buying stocks to flip them. I'm buying them for long-term positions. And again, classic, when you buy stocks, you buy low and you sell high. And so right now, Potash is in a low cycle. So hey, go for it. Again, the demand dynamic is still there. The world is growing. The populations are growing. The demand for more quality, healthy, nutrient-rich food is there. That's not going away. And potash is a critical material that goes into our food supply, so it's that factor. Now, from a financial perspective, the company also announced, which was kind of expected, was that they were going to slash their dividend, and they did slash their dividend. The yield on that stock was almost like 9 to 10%. It was crazy for a dividend to yield 9%. That's crazy. So they lowered it by 10%, which was not as much. People thought they were going to lower it by a significant amount, like cut it in half or something, but it was only 10%. It could be just the first phase. They might cut a little bit more, depending on how their business is looking. But yeah, when companies cut dividends, people want to head for the hills. But you know, me, I invest not for dividends solely. It's all about capital gains, capital growth, capital appreciation, because stocks are the riskiest component. That's why you invest in them. Other issue is in India. They kind of put a moratorium on imports on potash, which also was a negative play on the stock and the company. And so the bad news keeps going for potash. And so, but I really believe it's a really well run, really well managed business, and they're positioning themselves for the future. And so the short term may look really bad, but you know, I look at it from a long term perspective. Now, my final move that I made in February, it was a very weird move, and it's something I really don't want to, actually I don't even want to talk about it, but you know, I just want to put it out there because it's an issue I think we all face right now, especially if you're holding a lot of US dollar denominated assets. So what I did was I actually opened a position in the iShares Gold ETF, the Canadian version, ticker symbol CGL. Now, I didn't open it because I'm looking to make a trade on gold prices, because I have no idea where gold prices are going to go. It was really more kind of a hedge, not on inflation, but really hedging my US dollar exposure. And one of the things we've enjoyed is because the US dollar has been getting so much strength compared to the Canadian dollar, my US dollar assets, stock ownership has, we've caught like a prevailing wind and a tailwind, and it's sort of goosed our returns pretty nicely. But as much as that can happen on the way up, it can easily go on the way down. And so one of the things I'm concerned about is that we might see a sort of a turnaround with the US dollar, in that it might start to depreciate. And the reason why I'm thinking it might depreciate is really got to do with the interest rate picture. The Federal Reserve, embarked on an interest rate hike regime in December, but since then they've just really not talked about it. It just seems like they don't seem in any hurry to continue the program of increasing interest rates. Some of the data that's come out there has kind of shown otherwise, and some of the people in the Federal Reserve kind of getting cold feet. And so I wouldn't be surprised if the Fed just doesn't do anything for a while. And if they don't, then that's really going to create, people are going to say, well, why the heck we own US dollars? They're overpriced. And we could see a turnaround in US dollars. Now, if that happens and the Canadian dollar, on the inverse side of it, appreciates, then that's going to just devalue my US dollar assets. So I'm trying to figure out a way to kind of hedge that. Now, in the past, what I've always done is I've actually used an ETF. There used to be up here in Canada, used to be an ETF that would be like an inverse trade on the US dollar. So if you thought the US dollar was going to appreciate or depreciate, you could buy an ETF to reflect that position. But they don't have that ETF anymore, and the only one I could find is in the US, so it wouldn't make sense to buy a US dollar ETF in US dollars. It would just be like a double exposure to currencies. So I was trying to figure out how to wrap my head around a way that I could kind of get like a backdoor kind of hedge. And I thought, you know what, gold prices might be interesting, because gold and most commodities to a certain extent are in reverse trade with the US dollar. So if the US dollar appreciates, which it has been, it usually puts downward pressure on commodity prices, and that's what we've seen with oil big time, and metals and copper and all that stuff. It's gone. There's no coincidence that as the US dollar has gone up, commodity prices have gone down. As much as we can talk about the supply-demand relationship, that's been a huge factor. So if the dynamic changes and the US dollar goes down, then that would be an incentive for commodity prices to start tracking up again. And so that's kind of what I'm hedging against, is that if that dynamic should occur, by holding like a gold ETF, which is hedged in Canadian, hedged in terms of US dollars, I'm kind of getting a little bit of an appreciation in that ETF, which will kind of offset some of my depreciation in my US dollar assets. So I bought basically try to hedge about 25% so far of my US dollar asset position. And let's see what happens. I want to say it's very backdoor, very back of the envelope, but it's a cheap way to do it. And is it perfect correlation? No, it's not. I backtracked and see how these things correlate, and it's not the greatest, but it's the best you can get right now. The other way, suffice to say, is just invest more in non-US dollars, and that would be another way to do it. But just trying to look at a long-term, just looking for a way to preserve capital, because that's really what I'm all about trying to do here, is trying to preserve capital. And so it's a bit of an interesting, weird kind of way. I'm sure a lot of people will look at me and say, you're crazy to do that. And but that's what we try to do. Sometimes we have to try some things. So when I'm trying it out, if it doesn't work, I have an exit strategy to get out of it, so I don't lose all of my position on it. So let's see how it goes. So far it's interesting, because since I've done this, the Canadian dollar has gone from 69 cents to 75 cents. So there's been appreciation, which is what I was worried was going to happen. And since then, it's no coincidence that oil prices have gone up at this time, and the US dollar has gone down a little bit. So as you see, that dynamic that I thought would happen is actually happening. And consequently, the CGL, the ETF, is up 5% since I bought it. So so far it seems to be working at some level. It's not perfect. It's not, I'm sure somebody on Wall Street and whatever can slam it to the ground and do whatever you want. I don't really care. I'm just doing it. Bottom line is, I'm doing it because I'm actually putting my money where my mouth is on this. So whatever. So those were the moves I made in February, and And yeah, so you can go